Hello and welcome to the Savvy or Surrender podcast. This is Stephen Young and I am your host. This episode is sponsored by, of course, Savvy Tax Strategies and Bookkeeping, where we are your SOS for the IRS. So if you need any tax help, bookkeeping, payroll, or anything else with Profit First, we can help you out. Just go to savvytaxstrategies.com. And if you're checking this out on one of the many podcast channels, this is also a video cast. So if you want to go to YouTube and check us out there, especially for this episode, because we do have a lot of slides, we're going to be talking about the One Big Beautiful Bill, OB3, and go over some of what that means and how we can use it for tax strategies. So it might be helpful to check out the video there. Go to YouTube, search Savvy or Surrender, and click on the subscribe button, like the video. I would greatly appreciate it. And if you like this podcast, hey, I'm just getting started, so be easy on me. But if you appreciate this podcast, I would love a 5-star review. Again, it also helps the podcast to grow and to reach more people so that we can spread the message to, one, encourage business owners to use the Profit First accounting method so that they can be able to make more money. That's what it's all about for business owners, right? Is to be able to make more money, make more profit, and then using tax strategies to save that money. So that's the goal of this. All right. So without further ado, let's jump right into our One Big Beautiful Bill. It's over 880 pages. And over the last month or so, month and a half now it's been out, I've spent over 10 hours, at least over 10 hours at this point now, breaking it all down and seeing what it means. And now, so I did want to give a disclaimer, which of course, probably means that I've spent more time looking at this bill than what the people that actually voted on it did. But I did want to give one disclaimer, and that's that with all of the training that I've done on this bill, and I've taken it from a conference in Las Vegas, the National Association of Taxpayers Conference. Yes, I'm sure you're excited about that one, right? Wish you had been there, I'm sure. So I was there at that conference last month. And then I've also done a couple of other classes from two different tax professionals breaking down the bill. And there are some differences in what they feel like the bill is trying to accomplish and some of the wording in the bill. So that disclaimer just meaning this is what I understand the bill to be at this particular time, 6 weeks in. It might change. It will change as we go through the rest of this year. The good news is they gave us a lot of time before we had to worry about actually implementing the bill, right? Taxes aren't due for another 6 months or so. And so, or don't even allow us to start doing taxes for 6 months. So the IRS, the software companies, the professionals, we're all able to kind of figure out what the bill means before we have to start implementing it. So that's the good news. The bad news is that right now we still don't understand what it all means. I've got different teachers telling us different things about what the bill does. So that being said, I'm going to give it to you from what I know it, from what I've learned it, from the IRS website, from the actual bill itself. Yes, I actually read a large percentage of the bill in the synopsis of it. So we go through that, and this is what I'm going to present to you. Hopefully it's mostly correct, and I've done it to the best of my knowledge at this particular point in time. So with that being said, let's jump into this bill. All right, so tax planning considerations is really what we're looking at here. I am a tax strategist, so I'm not just simply going to give you the information and say, here you go, do what you will with it, but let's look at how the things that they've done with it, what it may mean for you as far as tax planning and tax strategy goes. And then also take advantage of being able to focus on 0% capital gains rate, right? Looking at different items in this bill of what we can do to be able to maximize your income from, or I guess I should say, minimize your tax liability, maximizing the income that you receive and keeping it rather than having to give it back to Uncle Sam. Okay, so some of the individual tax provisions is the Tax Cuts and Jobs Act had raised the standard deductions. The single was 15,750, or is now 15,750. Married filing joint is going to go up to 31,500. So those Tax Cuts and Jobs Acts, when they increased the standard deduction in 2017, those are now made permanent. They were supposed to sunset 2026. So now those are going to go up. They're going to continue to adjust for inflation, just like they have been. And then if you're over 65 or blind, you also get additional amounts. And that's current law. That's what it's been. Now, one of the misunderstandings of OB3 was the no more tax on Social Security. And even the Social Security Administration sent out an email a couple of days after the bill was passed saying, congratulations, there's not going to be tax on Social Security. And that's just not true. That's not how it works. What is happening is if you're over 65, you are going to get an additional $6,000 added to your standard deduction. Now, that is only valid through 2028. And then it also gets phased out depending on how much money you are making. So if you have a large pension, a lot of other investments coming in, even if you're retired, that money could get decreased. That $6,000 could go down based on what your income is. And so statistically right now, Social Security, the way it works, it's not always necessarily taxed. It depends on how much money is coming in, how much money you have besides Social Security. And only up to 50%, I say only, but only up to 50% of Social Security could be taxed. So they don't ever tax the entire amount of Social Security that you get. Right now, 64% of the population that receives Social Security do not pay tax on Social Security. So not everybody is affected by this. But by increasing the standard deduction, this is now going to decrease the amount of people that are going to get taxed on Social Security it's going to go up to 88%. So 88% of the people that are on Social Security, receiving Social Security now, will not have that amount taxed anymore because of this additional standard deduction. That's statistically, that's what the percentage are. That's what they've told us. So that's all it means. You still may have your Social Security tax. It just depends on what your income is. So some planning. Should you delay Social Security? Age 70, if you're hitting 70 this year, you should probably go ahead and hit it because that's the latest that you can delay it on. 62 is your earliest. And then review your required minimum distributions. If you have an IRA, something like that, look at that deferral. Make sure that you are planning that. But what could you do with that money? If you don't need that money, are there some charitable options there that you can roll that money into and be able to take advantage of that? And then there's another tax provision to talk about for individuals is SALT, the state and local tax deduction. So it was $10,000, and that is now going up to $40,000. For individuals or for married couples, married filing joint, $200,000. A married filing single, it's $20,000 if you're married filing separately or single, and then it's $40,000 if you're married filing joint. So you get $40,000 now for state and local taxes. So that includes if you live in California and you have a high state tax rate, if your property taxes are high, all of that, it used to be capped at $10,000, and that's now gone up to $40,000. So that could be a pretty good increase there for you to be able to write off some of those taxes. And that's going to continue to go up 1% each year. So it sunsets in 2030, where it then goes back down to $10,000, at least as of right now, if nothing changes, that's where it's going to be. And there are, of course, some phase outs for that as well. Casualty and theft loss were made permanent to where it has to be a federal disaster area. So that was changed also in Tax Cuts and Jobs Act. So if a contractor steals $5,000 from you because they were not legitimate, looking at my neighbor right now, you don't get to claim that on your taxes. And then the educators will no longer receive the unreimbursed employee expenses. Charitable contributions, 0.5% floor. So if you make $200,000 a year, you donate $10,000 to qualified charities, your new deduction is now $9,500. They are capping that with a 0.5% floor. So some things to look at, possibly some donor-advised funds, qualified charitable deductions if you're over 70 and a half, and some charitable financing. Should there be some life insurance involved in there or something like that where you can write off a larger portion of charity donations while only financing it. You only have to pay a certain, a much smaller amount depending on health and age and things like that. So if that is something of interest to you where you want to be able to donate a large amount of money to a charity of your choice, there are some options without necessarily having to give. If you want to donate $100,000 to charity, you don't necessarily have to have the $100,000 right up front. There might be some options there. And then gambling. It's always been where losses were only deductible up to the winnings, but now there is actually a 90% minimum there, or floor, I guess, maximum. So losses only to 90% deductible, and you still have to itemize. So you have to be itemizing, not taking the standard deduction. And then the child tax credit, that's gone up. The refundable portion, meaning no matter how much you paid in taxes, you're going to get at least $1,700 for each child. And then that's going to drop back down. You have to have a Social Security card. That's that's kind of current law. And then something new here, or it's coming back, I guess I should say, is the partial charitable contribution deduction for non-itemizers. So it used to be that if you didn't itemize, you could still claim some charitable donations, tithing to your church, whatever it might be. Now, and then that went away, and you had to itemize in order to get it. Well, we're going to get a little bit back. $1,000 for single, $2,000 for joint return. Cash contributions are still going to be maxed out at 60% contribution for cash gifts. So if you're just giving cash to a charity, you're only going to get 60% credit, and then you only get the $1,000 or the $2,000 for if you're married filing joint. All right, let's talk about the Trump accounts, or the money accounts for growth and advancement. Now, the financial advisors that I talk to, they ask me a lot, like, what are MAGA accounts? What are these? How are we going to do these? And the bottom line is, we don't really know yet, but we know what we're supposed to do with them. And so if you look at them, they're new tax favored accounts to benefit children under the age of 8, where parents would be able to contribute up to $5,000 per year to the account. And money cannot be withdrawn before the beneficiary turns 18. So it's not going to replace a 529 plan or anything like that. This is money that can be used to pay for college, first-time home purchases, starting a business. And withdrawals are going to be taxed at favorable capital gains tax rates. But we're not really sure whose capital gains tax rate yet. So the parents, the kids, probably the kids, because they'll be over 18 by the time they're pulling it out. And then the $1,000 for government deposits for qualifying children born between December 31st, 2024 and January 1st, 2029. How do you get that money? That is a fantastic question that we don't know yet. All right, so some tax planning. Employers can contribute up to $2,500 per employee to their child's Trump account. So this could be an opportunity to be able to give a fringe benefit to some employees, and also be able to, you're writing that off, right? It becomes an employee fringe benefit. And so you're able to write off $2,500 per employee, but you cannot discriminate. So you can't say, hey, I'm going to offer it to my kids, but I'm not going to offer it to my other employees' kids. So if you have a lot of employees, this may not be of interest to you. It could be too large of a amount that you have to pay, but it is an option. Okay, let's talk no tax on tips. So tip income is going to be temporarily deductible up to 2028 or through 2028 as of right now. And it is still subject to payroll taxes. First of all, it's only up to $25,000. And you still have to pay FICA. So the Social Security, Medicare, that's 7.65% of your paycheck is taxed for that. That's still going to apply. It's just the withholding, and your state tax, if you have any, that is going to be no longer taxed. And it's only for specific industries that are customarily tipped. So, what are those industries? That is a great question. The IRS has to come up with that list by October 3rd, 2025. So, we don't know as of the time this is being recorded, we don't know exactly what industries those are, but those that are customarily tipped. So, we can pretty much guess which ones they are. Not me, unfortunately. I don't get to change all of my tax preparation clients to a tipped and not charge them for the return and just ask for a tip. That won't happen, I guess. Okay, no tax on overtime. Only the premium portion of overtime pay accounts, that is the amount over the regular rate as required under the tax or under the overtime rules. So in other words, when you make time and a half, right? So if you're making $20 an hour and now you're making $30 an hour, it's that extra $10 an hour that is not going to get taxed. And this is going to be a transitional rule. So what that means is if you think about your W-2 that you get at the end of the year, nothing shows you how much overtime you actually made, right? It's on your pay stub. So if you look at your last pay stub for the end of the year, it'll show you there, but it doesn't show you on your W-2, which is what you normally give your tax professional. So how are we going to track it? And how are employers going to track it? That is a fantastic question. I'm sure payroll providers right now, like Paychex and ADP and all those guys, are trying to figure out how to add it to the W-2. It could go into box 12, which if you look at your W-2, there's kind of some extra, there's like 4 spots there that you can put different information. That's usually where your health insurance and your 401k and things like that go. So it might go there, or there's going to be another box or something like that to be able to track it. But that's the rules right now. So if you are an employer, you want to be able to make sure that you are tracking that overtime, or you have a system that is tracking the overtime. And the reporting and payroll implications that we just talked about, that make sure you track it. And then car loan interest, only for cars assembled in the United States. Deduction is limited to $10,000, and there's some phase outs, of course, for depending on your income. But this is something where we haven't had this for, I think it's been like 30 years or something like that, where we were able to deduct the car loan interest on a personal vehicle. So we have that opportunity as long as it's been assembled in the United States. So you want to ask the dealer. It doesn't have to be a new car too, by the way. It has to be brand new. So some opportunity zones have been made permanent. They've narrowed the definition of a low-income community. So there's definitely been some changes in the opportunity zones. And there's also a bit of a challenge. These changes take effect on January 1st, 2027. And so the new zones are going to be rolling out, which means in 2026, there are no opportunity zones. So you'd want to watch out for that if that's something that you've been taking advantage of. But there are some great opportunities there. Okay, let's talk about energy credits. Now, the energy tax credits for a vehicle are going to expire on September 3rd, 2025. So previously owned clean vehicle credit, the clean vehicle credit, and the commercial clean vehicle credit all expire. My personal opinion, this is Donald Trump's thumb to Elon Musk. That's, I think, they had that little tissy fit that became, or their Twitter battle or whatever you want to call it. Whether it was real, made up, I don't know. But the one big beautiful bill came out right after all of that stuff was happening. And all of a sudden we lost all these solar credits. So I don't know. I'm not a political insider. I could be wrong, but it just seems awfully convenient that that happened. And then also expiring, these are kind of out of order. So let's go down to the bottom one here. The terminating or ending on December 31st is your energy efficient home credit. So all of those solar salespeople that are going door to door saying that you've got these solar credits that you can get, and they don't really know what they're talking about, whether it's refundable or non-refundable, whether you even pay taxes. Anyways, those are going away. They're going to my neighborhood all the time, trying to get me to buy solar. And of course, I was a sucker and actually did it. But I did get that energy tax credit, so that was nice. So anyways, it's going away. And then June 30th, 2026, it's going to go away on commercial buildings. So Should you get solar credit? That is a fantastic question, and that's going to be the topic of another podcast that I'm going to break down for you how solar and roofing all makes sense and how it could be advantageous for you, especially if you run a business out of your house, how that might be able to help you and how you can deduct some of that and get some depreciation out of it. So we'll talk about that, but you will have to move fairly quickly if you're going to do that and be able to get the credits for it. All right. Business tax changes. The QBI, or qualified business income, was made permanent at 20%, and there is now a $400 minimum. So that was helpful. And bonus depreciation has been made permanent at 100%. So bonus depreciation came about with the Tax Cuts and Jobs Act, and it started at 100%, and then it went down, and it went down to 80, and then 60, and then 40 this year. Well, now anything that you purchased after January 19th, 2025 is going to be permanently at 100% bonus depreciation. So that, and then also the Section 179 limit went up. So not only do you have the option for Section 179, if that makes more sense, but you also have the bonus depreciation at 100% if that makes more sense. So what this means for the majority of real estate investors and business owners is that you can really look at purchasing bigger equipment. You can look at it with real estate investors, as long as it's not a fix and flip. Obviously, we don't depreciate those because you're not holding on to it. But if you're going to hold on to a property for a while, we can look at using cost segregation and depreciate some of that, those items that would normally be segregated out. We're going to be able to do that a lot faster. And so it's a great opportunity to be able to take advantage of those rules, to be able to write off more depreciation upfront, if that's something that makes sense for you. Also, equipment leasing and oil and gas opportunities, two tax strategies that I love to help with my clients. That is going to be another opportunity that we can use the bonus depreciation on and do it faster. Corporate charitable contributions, there's a 1% floor, and it cannot exceed 10% of taxable income. It will be carried forward for 5 years. And then the pass-through optimization becomes more important. So with enhanced deductions and potential phase-outs for high earners, S-Corp salary planning and guaranteed payments and partnerships are now directly affecting your ability to claim full deductions. So if you have a poor structure, you may lose some deductions. So you definitely want to talk to your tax professional, or me if you don't have one or you don't feel like yours is doing their job. And we can make sure that your S-Corp, your partnerships, everything is set up correctly so that you can maximize the deductions that you're going to receive. And then some of the OB3's benefits are tied to thresholds, of course. The entity that you choose can help split or shift income, for example, using multiple entities or spouse strategies, and it controls how and where your income shows up on your tax return. So what that means is, again, look for a tax professional that knows what they're doing, where, when you have multiple entities, that income is coming into, what deductions that you'll be able to take. And then some advanced strategies require the right structures. So the most powerful tools in the tax code, like equipment leasing, conservation easements, cost segregations, or the qualified business income or optimization, they often require an entity to unlock or to structure that correctly. So if you're just simply a sole proprietor, or even if you're just a single member LLC, that's in the IRS terminology, that's called a disregarded entity. Basically, you're still just a solo provider or a sole proprietor on taxes. And so you get what's called the Schedule C on your personal tax return. You're not going to be able to optimize all of the different opportunities that OB3 has created. And so again, talk to your tax professional. And there's going to be additional IRS scrutiny. They still have a lot of funding for enforcement. So you heard about all the layoffs and things like that Trump was going through, and Doge and everything. They're still finding and hiring enforcement. And so poorly structured businesses or aggressive gray area strategies in the wrong entity are at higher risk. Proper entity setup helps defend your position. If it's still illegal to do, and whatever tax strategy you're taking, it's still going to be illegal regardless. But my point being is that if you are a sole proprietor or a single member LLC, if you're just simply reporting on a Schedule C on your taxes, that is more likely to be audited than if you are an entity like a partnership or an S Corp or a C Corp. Statistically, that is what we see. Looking for a professional, you can contact me at meetwithsavvy.com. I have a 30-minute free discovery call where we can talk about your specific business and tax issues and figure out if we are the right fit. You can also go to savvyceoalliance.com for more information. And we're building a community there. It's a small one right now, but we're building it up so that we can get more people in there and more. The goal of Savvy CEO Alliance that I've created is I want to help business owners to understand how to be business owners. So it doesn't just have financials and profit first and taxes in there. Right now, that's pretty much what's in there because that's what I'm building up. But the goal overall is going to have more information, not only talking about the entity structuring and taxes and things, but also down the road marketing and what you need to fix next in your business. And so as I do the podcast, those episodes are going to go in there. It's free to join. It's, again, savvyceoalliance.com. And again, if you're on YouTube there, you can scan that QR code and that'll take you right into there. It's a great community. Just request to join. We'll get you admitted and you'll have a lot of information in there, and it's just going to continue to build up. So with that said, again, check out YouTube and subscribe, like this video. If you're on a podcast, I appreciate you listening. And, if you, again, feel like I deserve it, I would appreciate that 5-star review. We're only going to get better. This is episode 2. And, they say it takes 100 episodes before you really feel in your own. So I've got 98 more episodes to go before I feel like I know what I'm talking about and know what I'm doing here. So anyways, with that, have a fantastic rest of your day.